we issue a sell recommendation for a target price of $3.80 for Central Puerto. But we have the strong conviction that despite a 17% upside, the country political and regulatory risk does not compensate this upside in the price. We base this conclusion in three main pillars. These are the country risk and uncertainty, regulatory risk, and the concentration and dependence of revenue. The first one talks about the history of Argentina, of political and economic turbulences. High inflation, low growth, and currency devaluations seem to be a challenging and difficult scenario for this company. In addition to this, the government in the last months took the measure to impose foreign exchange controls that limit the access to US dollars in the market and the repayment of debt. Secondly, we see this industry as a fully and heavily regulated sector, with high dependence of tariff schemes determined by the government. We link this one to the possibility of a specification of tariffs with the government that took place now. And the third one talks about the concentration and dependence of the revenue in Argentina. We see this as a main risk for the company. Then we observe a high correlation between the GDP growth of Argentina in the last 20 years and the energy demand growth of almost 80%. We observe that the private sector represents 61% of the total market share, being Cepu, Pampa, ICE, and Enel the main competitors. We see this industry as a really regulated one. Then we have CAMESA, which is a non-profit corporation managed by the government and private sector companies. Then we see the effects the Resolution 1/2019 had in Cepu's revenues in 2019. We link this to the specification of tariffs and see as a big risk and uncertainty for the company. Finally, we observe the difference between the execution administration and the macro administration in operating margins that we see as a big challenge for the company and pose a big risk for it.
Cepu operates in 7 provinces. It has an installed capacity of 4,200 megawatt per hour, with an additional 510 under construction. Regarding Cepu's main strength, we want to say that it's one of the largest private generators in Argentina. The strategic location of their plants, which benefits the transportation cost of gas, the engineering team and management with vast experience in the sector, and the efficient plants under construction, which will bring better margins than existing plants. On the other hand, and in relation to the weaknesses, we want to say that it operates in a fully regulated sector, that the majority of the revenue is paid by the government, their full dependence on Argentina's economy, the political risk, and the concentration and dependence of the revenues that we'll talk further in the next slide. Regarding the concentration and dependence, first of all, we want to say that almost 90% of the revenues came from energía base. That type of energy is paid by the government, and also they determine the tariffs, and we see a high risk due to the reduction in tariffs that the government will be proceeding. Then, the Adelaida plant operates under a concession agreement with the government, which expires in 2023, and we see this a big business risk, as there's uncertainty around the renewable or not of that concession. And this plant represents almost 30% of Cepu's generation. Finally, we want to say that Cepu has a stake in 3 companies that are known as Fonimemem and Cebeosa, according to 2 agreements with the government. Those agreements were created in order to repay outstanding balances from CAMESA to the generators, and we believe that the government will be diluting that stake.
In this slide, we compare the return on equity between Cepu and Pampa through the DuPont analysis, considering that Pampa is one of the most important competitors of Cepu. The return on equity of both companies has been still improving in the last few years. In the case of Cepu, mainly due to 2 factors. Firstly, the increase in tariff resulting in an increase in net margins, and secondly, the high leverage rate. However, for the following years, we consider that the ROE of Cepu will be lower and remain stable in 17%, mainly due to key factors. Firstly, the reduction in the tariff and specification effect affecting the net margin of the company, and secondly, lower leverage ratios due to the lack of new investment. It is also important to highlight the huge difference in return on equity and margins between the Macri and Kirchner administration, which reinforces the potential downside of the share price and supports outside recommendation. Finally, it is important to highlight something about the industry, that it will be a lack of financing due to the macroeconomic scenario of Argentina. This means that CEPU will have a significant lower investment in CAPEX, affecting the future growth of the company.
Regarding the valuation, we consider two different methodologies, the DCF to equity and the multiple valuation. These are the main assumptions we estimated for the DCF to equity, and as we can see, we obtained the energy demand for CEPU considering two factors: the correlation between GDP growth and energy demand growth, and CEPU's market share. And then that energy we split within two categories: energía base and new energy and renewables. The price for energía base was determined considering 2019 prices and also considering a specification effect for future years, and the price for new energy and renewables was linked to the price of energía base. Then the cost and expenses were determined considering the energy produced each year and the inflation rate we estimate. Regarding the discount rate, we estimated through the capital asset pricing model, and we consider a risk-free rate that we obtained from the 10-year US bond, then the market premium from information of Damodaram, published by Damodaram, and also the beta for the industry that we obtained also for Damodaram. Then the country risk premium was obtained from the emerging market bond index published by JP Morgan, and finally a size premium of 3.6% according to publication done by Duff and Phelps in the past. Finally, in the DCF to equity valuation, we reached to a target price of $3.66 US, and to reach that price we have to determine a terminal value for which we consider the Gordon growth model, specifically with a perpetual growth nominal rate of 5%, and then we perform a sensitivity analysis considering the cost of equity and perpetual growth, and from that table we can conclude that these two variables seems not to be of huge impact on the target price. Regarding the multiple valuation, these are the companies we identify as peer companies of CEPU through a research of the companies within the industry, specifically Latin American companies, and we select the harmonic mean of the total enterprise value to EBITDA multiple to reach the value of 4.13 US dollar. Then we weight these two valuation methodologies with a 70-30 rule, reaching an overall target price of 3.8 US dollar. And to conclude, we want to issue a self-recommendation because we think that this is not a good moment to invest, not specifically in CEPU, but in the Argentinian energy industry, and that's because of the three key factors that we mentioned before in the presentation. The country risk and uncertainty, specifically if we consider a return of equity forecasted by us that is lower than the cost of equity. Secondly, the regulatory risk and the concentration and dependence of the revenues. And we confirm our thoughts when we perform our Monte Carlo simulation, in what we can see that the self-recommendation scenarios predominate. Thanks for your time.
I believe that you did a very good analysis, trying to understand what happened in the past in Argentina and try to bring that scenario to the present, because probably that's going to happen in next years. At the same time, I want to understand if the company right now is not the same as 10 years ago, because now it has renewable projects going on that will come in place in the next 2 years. And I want to understand if you consider that, if you brought all the assumptions from the past to the present, trying to plan to a different company, and trying to understand that it will impact in a different way on the margins of the company and the operations of the company that it did in the past. Did you do that? Did you put it in a way that understand that the company right now is not the same as 10 years ago? That's my main question.
Yes, we consider that, and we identified two different type of between through the Kirchner administration. the last years of Cristina's administration was not too bad in margin, and we try to focus on trying to bring margins in line with 2014 and 2013, and that's because one of the things we said that the company is now better than in the past because of the investment in capex and all the new investment that they are doing.
Yes, additionally, and what you said about the renewable energy, that it's a fact that the CEPU is investing this year, last year, and that type of energy at this moment is bringing better margins, and we think that in the future will also bring better margins, but not. We are not thinking that those prices, those tariffs in dollars, even if they are with the private sectors, will maintain, because we assume that the government will reduce a lot the base energy, the energía base, and then will be a gap too huge between those prices, and we think that those contracts will not be respected, it will not be concluded, and so we maintain that gap of multiplied by three times between the energy-based tariff and the renewable energy.
Because we think that if I'm a private consumer, if I have a contract signed with CEPU that is 10 times bigger than the price I can pay in the spot market, I think that in that situation the things are going to be a huge difficult for both parties.
Imagine that I'm a contrarian investor. I really like this stress situation, and you tell me this is not the time. What is the time window of this recommendation when you are introducing the sell recommendation? Do you have an idea of this? And the second part of the question is, I'm really a contrarian and I would like to buy. What is the key factor to follow with this just to open a possibility to buy?
I think that we should see again this. This is our main assumption here. If you see in Kirchner administration operating margins, CEPU and the energy sector, there's a big difference between the Kirchner administration and Macri administration, and that's our main fact. If you say I want to buy, I will show you this graph. Margins are not the same than the last 3 years.
Yes, and we think that these margins are going to be with this new government. So we didn't think that with this new government, the country risks, the political risks surrounding the industry is the moment to invest. We think that there are too many and huge impacts of these risks to invest in this moment.
Yes, we are in the meantime of a transition, so we need to. If you are too focused on buying, you need to wait 1, 2, 3 years at least and see the new regulation, and then think again. But this moment is not a good moment to invest in energy industry in Argentina.
Also, we want to highlight that the economic context it was not the same these years, the first year of the Kirchner administration, that we have today. Here we had a boom in commodities price, an economy that passed through a crisis and was recovering and had everything to go up, recover. And now we have a really difficult situation, recession, fiscal deficit. I mean, they are different. Yeah.
For you is, if I have a better visibility of the margin of the company because of the regulatory prices on this government, for you is not enough. You need to see a better visibility of prices and a GDP growth just to beginning to invest.
Yes, and specifically in this industry, the new president of Argentina told sometimes that this is one of the industry he wants to attack in the good way of the word, like regulate or
and lower the margins.
Okay, but in addition, what is your projection of this operating margin? That line is going down and is going down forever. Your terminal value, you assume that is low, that it maintains low the operating margin? Because your valuation is a terminal value, so you are taking an assumption that my question is if this is in the long term.
In next years, it will go lower, and then we project that they will maintain stable. But with that number, with that margin, you achieve a return on equity of 17%. So nowadays the cost of equity is around 28. So the company is not adding value. With saying that.
And we go back to margin of again, we separate education administration between two. We are going back to the margin of the last years of education administration, not the first one.
Okay.
Not too bad, just bad.
I have one question. When you did the DCF evaluation, you chose to use the free cash flow for equity, and given the capital structure of the company that has debt is low, but it has debt, why didn't you use the free cash flow to form to make all your free cash flow projections for the future?
We consider because a big part of the debt was taken in the last 2 years, and we think that going directly to the free cash flow to equity and then like we have recent information that we could discount the repayment of debt directly from the cash flow and not then after the calculation. And that's why we assume a cost of equity discount rate and not a WACC.
Can you move to the slide when you have all the projections on net income and other?
This one?
No, you showed on the presentation. That net income that you have there is the margin. Is the net margin of the company?
Sorry?
The net income line is that is the net margin of the company?
Yes.
So you assume it's going to grow in the next few years, not going to go down.
Yes, but it will going to grow from 19 and maintain stable until 23. But if you let's go to the financial ratio. That 40% is similar to the one in 2015, the net margin. And then if you see in macro administration it's 50, 60, well the 120 due to the CBO's effect. And so will be back to 2015 numbers.
And additionally, this net margin increased in the last few years as a consequence of the renewables and energy. That this energy is going to be higher or in a higher proportion of the total revenues, and these revenues has a higher net margin. So if you